Hello, everybody. Welcome. My name is Maria Llanos. I am here with the NCEO today for today's webinar. We're going to jump into our content here in a minute, but as everybody gets in and gets settled, I'm going to go over some housekeeping things real quick. So today's presentation, Optimizing ESOP Success, Accounting and Valuation Essentials. We're joined today by Zach and Dan. Welcome. As always, we like to take a moment to thank our sponsors. They are the ones that come with us every single week, put on the content, and partner with us, so it's always a pleasure to work with them. As a reminder, today's webinar is free if you're an NCEO member. If you've got questions about that membership, go ahead and find this contact info here. They will be able to answer any of your membership-related questions. For today's webinar, if you've got questions, we welcome them, love questions. Do not hesitate to ask them. You'll see at the bottom of your Zoom panel a Q&A feature, and that's what we're going to ask you to use. Our presenters today are going to watch for those as they happen, so throw them our way. As for CE today, you will see that there are 3 polling questions we'll go through. Those will pop up throughout the presentation. You should see those come up on your screen, and those are required if you're looking for CE. Otherwise, if you're not looking for CE, please also just throw your best guess in there. There's no right or wrong answer to these. If you're looking for CE, we just ask for your participation. That's CPE and generic today. And then any questions you might have about that, you can send me a message in the chat. You can also send an email here to this email inbox. We will be able to help you get your certificates. The only other requirement we ask is you stay for the full 60 minutes of today's webinar. Moving on, as for the slides for today, those are posted on our website. So if you navigate to today's web page, you will find a download button. You can access those now or later if you would like to follow up on any of the content. On that same web page, you will find later today, we'll upload the recording of this webinar. So if you'd like to follow up, revisit any of the content, that's there for you to access. And last but not least, coming up on Thursday, we've got a service provider webinar on releveraging. And then, of course, looking forward to the end of August. We're going to see many of you here in the next few weeks in Philadelphia joining us. If you haven't yet registered, that link is here. And then coming up in October, another in-person event. We've got 2 is an ESOP right for you or ownership in action. That's happening in Baltimore at the end of October. That link is here, and I can send those out for information if anybody would like to learn more. With that, I will be here ready to answer questions. I'm going to let Zach and Dan take over now. And if you need anything, please don't hesitate to send me a message.
Thank you, Maria. I'll introduce myself, and then Zach can introduce himself. Thanks for joining us today. My name is Dan Seiler. I am a valuation director at Stopper & Miller. We are headquartered in Indianapolis, Indiana, with offices in Cincinnati, Fort Wayne, New York City, and most recently, Chicago. So we're excited about that recent event. One thing that we may mention as we go along here at some point is KSM has been an ESOP company ourselves since 2001. So not only are we able to service our ESOP clients and their accounting, tax, and valuation needs, but you know, some of the issues resonate with us personally as well. So that's kind of been nice going hand in hand with our services.
Great. Can you guys see this okay? My screen, good, okay. I'm Zach Kubly. I'm a director here at Stopper & Miller. I have a background in tax. I work almost exclusively with closely held businesses, and a lot of those businesses happen to be employee stock owned companies, and so I have the pleasure of working with ESOPs on a day-to-day basis. And so what we thought we would do is give you guys a little bit of background on some accounting and valuation essentials here, specifically for ESOPs. We got a lot of material to cover. And so we'll kind of go quickly through it. I have 2 examples or case studies. If we have time, we'll get through it. If not, it can just be there as a helpful resource to you. And as always, if you have any questions, don't hesitate to follow up after the session with Dan or myself, and we'd be happy to talk or help through this. So yeah, so we're going to be covering some of the first year accounting for ESOPs, and then some things to think about from a valuation side, in planning for the timing of when you're going to be doing the valuation, and then the review of the valuation there annually. So learning objectives, here they are. We've got best practices for ESOP accounting, making the most of your accounting and valuation annual cycle, and then understanding just kind of how the valuation review process works. So to jump into it, so first we're going to talk about the accounting for new ESOPs. What we like to, I guess, spell out is the difference between a non-leveraged ESOP and a leveraged ESOP. You'll see both kinds. Often we'll see a leveraged ESOP, but we'll talk about both. We've got, if you're talking about a non-leveraged ESOP, this is an ESOP with no debt related to the initial share purchase. And so cash contributions can be made by the company to the ESOP, which is then used to acquire the shares for the employees, or maintained in the investment account. So leverage account or non-leveraged account, that's what that is. A leveraged ESOP, which is probably why you're all here, because this is where the accounting complexity comes in. So this is where financing is used to purchase the shares of the company, and then those shares are allocated to the participants over time as the debt is paid down. So just some basics on non-leveraged ESOPs. You think about these very similar to a retirement plan that you have if you're used to making retirement plan contributions. This works very similar. If you put cash into the ESOP, that's your expense. So the compensation expense is cash contributed to the trust, or if you contribute shares directly, the contribution expense is calculated as the average fair value of the shares contributed. And so the rest of this will focus more on leveraged ESOPs. And so there's a lot of terminology that's helpful, and we'll go through this quickly, but you can always come back and reference this. But there's just things that you got to just keep in mind, or you always have to refer back to. But so you've got a direct loan. So this would be if a third party like a bank lent directly to the trust to acquire the shares, which is maybe less common. You've got the term indirect, or sometimes you'll hear it called inside loan, or sometimes you'll hear it called employer loan. This is where the company lends money directly to the trust to help facilitate their acquisition of the shares from the original seller. You've got an outside loan, which that's like you would think a third party lender lends money to the company to facilitate the transaction. And then another concept that we'll show an illustration of later is unearned ESOP shares. And this acts as a contra equity account on the balance sheet. So if you're unfamiliar with ESOPs, but you're very familiar with looking at a balance sheet, if you pick up a balance sheet of an ESOP company, it might look a little funny to you, and we'll show you an example of what this looks like in a bit.
Zach, what percentage of the ESOP companies you deal with are leveraged ESOPs?
I would say the vast majority of them are leveraged. There are a few that I work with that are more they've been around for a lot longer, and they've kind of worked through their initial release of shares, and so tends to be more like the mature ESOPs that I work with are not leveraged anymore.
Yeah, and there's a way, there's a re-leveraging. That's one of the topics coming up that Maria highlighted. I don't know if Zach and I are going to get into the details on a re-leverage transaction, but that's what that means. It's essentially where there's another loan made by the ESOP in order to acquire more shares to be allocated to the employees. So it's all a part of the ESOP life cycle, so to speak.
Yep. And then so this next slide here, I think Dan was going to talk about just a typical picture of. We always think it's helpful to look at an illustration when we're talking about this kind of a transaction.
Yeah, and if this doesn't make sense, if you are at a new ESOP and this just doesn't make sense, just that's okay. I remember the first time learning about ESOPs, it took a while to really understand how these different entities are related to each other, especially when you start doing journal entries and so forth. So in this example, what we see in the top here, the bank lends money to the company. Okay, the company is the sponsor of the ESOP. The company takes that cash from the bank loan and directs it to the ESOP trust. So that's this new entity that's formed when the ESOP is created. That trust then purchases the stock from the selling shareholder. The shares that the ESOP acquires are held in suspense inside that trust, and they're not allocated at first until the company makes ESOP contributions to the trust. And numbers 2 and 5 there kind of illustrate this. That contra equity account called inside loan is what's created between the company and the trust when the company initially transferred cash to the trust to purchase the shares. So the ESOP owes that money back to the company. The company makes annual ESOP contributions, but they're just repaid right back. So you see those two arrows, number 2 and 5, those kind of offset. They used to, a long time ago, they used to mirror the terms of the bank loan with the company. So sometimes you might hear it called as a mirror loan, but it is a different loan than the bank and the company. That's just normal financing. That the terms of that could be, a 5-year amortization, 7-year amortization, 10-year amortization. The amortization and terms between the company and the trust depend on the benefit level that is targeted from those involved in forming the ESOP. It's an employee benefit created, and you want it to be meaningful, but not too meaningful. In other words, the faster the shares are allocated to the employees, there may not be shares left over for future employees. So it's something that's it requires a lot of analysis and diligence to figure out how long you want these allocations to occur over time. If your transaction involved a redemption, that's not reflected here, but that is common for a corporate redemption to occur just prior to the ESOP stock transaction. Also not reflected on this slide is if the seller remains a note, there could be another set of arrows between the seller and the company, but we're not showing those. So again, this is just one example. Let's move on to the next slide. So this basically shows after the transaction what happens. So the company owes money to the outside lender, the bank. So those payments just occur according to the terms of that loan. And then numbers 1 and 2, you'll see the company makes a retirement contribution to the trust. That's an annual contribution, just in the same fashion that the company may make a 401k match, for example, or some kind of profit share. They make a retirement contribution to the trust, but then the trust, remember, owes that money back to the company. That's that inside loan. So that cash, and Zach might tell you it's not, it's cash, but it's not really cash because it goes in and then it goes right back out to satisfy the inside loan.
Cash moves, but yeah, it comes right back. And so the net, it's essentially a net zero cash transaction.
But when that happens, when that loan is repaid, that's what releases the shares to the ESOP beneficiary, the employees. And then the goal, if we step back and look at the big picture here, you want the company to repay the debt to the bank. That if you reduce debt, that increases equity by definition. So you have a couple things happening. You have employees that are hopefully motivated by this new corporate structure that they can participate in. So the goal is for them to stick around and accumulate shares every year as the company makes contributions. Simultaneously, hopefully the value of those shares is increasing as debt is reduced, and as the company hopefully performs well and becomes more valuable. So the goal here is to build value for the ESOP beneficiaries so they can retire at the company and have some form of a nice nest egg. There's one more picture here that we can look at, and this isn't really specific to the trust itself. This is targeted towards maybe those of you that are truly learning about an ESOP for the first time, or maybe your company just formed the ESOP. This reflects essentially the initial debt. An ESOP is a leveraged transaction, and sometimes there's a bank involved, and then sometimes there's a seller note involved. So what this tends to show is the seller note usually doesn't get principal repaid until the bank is repaid. So basically, this just looks at leverage over time, and it shows the bank note principal is repaid over 5 years. There's no amortization on the seller note during that time. Maybe the seller is giving some interest payments on their seller note. But then when the bank is repaid, the seller note, because it's behind the bank in the capital stack, that's the market will say that's deserving of a little extra interest or higher rate than the bank because it's less secure. So maybe it has a higher stated interest rate, or maybe there could be a warrant attached that can give a higher overall IRR, or internal rate of return, on that note. So sometimes what we see is when the seller note exists after the bank is repaid, the bank will just refinance out that seller note because it's cheap. It's a cheaper cost of capital generally. So that's kind of that light blue triangle in years 6 through 10. Once you kind of make it through that, the company is debt free at that point, assuming no other loans. And then if there was a warrant attached to the seller note, generally there's this period of time where the warrant is cashed out in some fashion, depending on the then value of the share versus the initial strike price on the warrant. A warrant is it's kind of like a stock option, is a way to think about it. And that's designed, again, it saves the company cash payments on the seller note for a potential future payment, depending on the value of the company in the future. And you'll note this big arrow on the top. As employees accumulate shares, as debt is repaid, and as the company's value grows, that creates this obligation. The employees have this put option to exercise their shares. So that repurchase obligation is something that needs to be managed. So someone at the company needs to have a very good idea, and there's a lot of good resources. There's ways to model out what that repurchase is going to be, but it's definitely an important part to be aware of, and how to successfully manage your cash flows as it relates to the ESOP. Anything else to add on this chart, Zach?
No, yeah, I just think, this repurchase obligation becomes very important. I mean, just something you always got to be mindful of, keep that in the back of your head from the onset. Like, hey, the whole point of this is to provide a benefit for the employees, and the only way to do that is to buy those shares back, and so you got to have the cash available to make sure that happens.
Yeah. Before you continue, there's one question that I'd like to address. Is there a typical number of years an ESOP would pay off the initial debt so they are no longer leveraged? It depends which debt you're talking about there. If you're talking about the initial debt from the external financing with the bank and the seller, that's often 5 to 10 years. If it's the inside loan, it depends on the benefit level. I have seen, and it also depends if it's 100% ESOP versus a minority ESOP, like a 30% ESOP. The smaller the percentage, typically it's the amortization is a little bit quicker in order to enhance the benefit level. So it's an actual meaningful benefit to the employees. We've seen,
I would agree with that. I mean, I guess there's a tendency nowadays to want to maybe stretch out the inside loan so that you can help manage that benefit level to the appropriate amount that your company is aiming for their employees. And oftentimes the shorter that is, the higher the benefit level that is kind of paid out initially. And so there's a whole bunch of different factors that go into that, and it's probably its own training. I'm sure NCO has a session just on that. But yeah, it's all over the board, and it's kind of one of these things where all ESOPs are different, and they're all kind of like snowflakes, and each one of them is unique in its own way. And so it's one of those things that you just got to find out what's right or best for your company, and that's through careful analysis and a strong team of professionals helping you through that.
I've heard of some recent cases where you have the expectation of a lot of value creation in the future, where the inside loan is over 100 years. So it does definitely vary by company.
Yep. Okay. So this next section here, we'll start talking through a case study, just to show you kind of the mechanics of in journal entry form. The picture that Dan went through, we'll see what that looks like when you put pen to paper on your actual accounting here. So for this example, we're going to assume that we're talking about an S corporation that sells 40% of its stock to an ESOP. So not 100% owned by an ESOP. The company has 100,000 total shares outstanding, and the value of the shares is $75 a share. And so that 40% or 40,000 shares then is equal to this $3 million. And so that $3 million is that initial inside loan amount that the the trust is going to need. So if we take a look at the balance sheet of this company before the ESOP transaction, obviously this is super simplified, but we got assets at 10 million, liabilities of 5, and equity of 5. So hey, we did our job. That it flips here to 0, so we're good. Assets equals liabilities plus owner's equity. But then if we talk about what the balance sheet looks like post transaction, so in our example, you still have the same $10 million of assets, the original $5 million of liabilities. But hey, we got this new outside loan ESOP debt. So it's an outside loan where they went and borrowed money from a bank for $3 million. Equity before the unearned ESOP shares, that same $5 million. But then now here's where we've got this kind of unique to ESOPs presentation here in the equity section. We've got this unearned ESOP shares, and what that represents is these shares that were purchased in this leverage transaction. And what it is the original cost of the shares that have not been released to the trust such that they can be allocated to the employees in their retirement account. So yeah, it looks like we got our first polling question.
For
Yeah.
everybody, I'm going to launch that polling question for you here. Loving that everybody's doing their questions. Please feel free to continue those. This polling question reads out: how are unearned ESOP shares classified on the ESOP company balance sheet? Those answer choices are asset, liability, and contra equity. Just as general practice today for everybody, I'm going to give everyone about a minute to answer this, or until we have majority, and then I'll do last call for everybody. It looks like I've already got 71% of you answered here. And as a reminder, if you're looking for CE, this question is required. You don't have to answer it correctly, but just give us an answer.
And we just went over it on the last slide.
Okay, I've got 85% of you. I'm going to give everyone about 10 more seconds to get their answer choice in here. And then I'm going to close this out and share our results so we can all see.
Okay. Yeah, so the answer here is contra equity account. That's that debit in the equity section that we just talked about on the financial statements. So moving along here. So a couple more things to point out related to the accounting here. So if we're thinking about the annual contributions to the trust, so how's the trust getting assets? So this can be done through cash contributions to the plan. This can be done through dividends or distributions, depending if you're a C or an S corporation. Some combination of the above, or the company can issue stock directly to the trust. One thing to keep in mind here, there's a contribution limit. So the ESOP plan is an ERISA-based plan, so there's retirement plan rules that you got to monitor and follow closely. But the annual contribution is limited to 25% of eligible compensation for the participants. And sometimes, because you got to think, hey, you got to have enough money coming in to the trust to be able to repay that inside loan. And so sometimes if you do run afoul of that and your contributions needed are more, some way to supplement is to use dividends, issue dividends to the ESOP such that they can use those funds to repay that inside loan. Okay, so cash contribution accounting. So company contributes cash to the trust bank account. That's recorded as an expense. Contribution portion used to pay the interest. This is just something to note here, should not be recorded as contribution expense. This is recorded as interest expense. And so you'll see this as part of the journal entries, but essentially there's an interest expense component. And then on the repayment of the loan, you would think, hey, we got interest income coming from the trust. Really, you're supposed to hit it to that same interest expense account such that they net to zero.
Hey, Zach.
Yeah.
Somebody asked a question that's kind of related to that. So
Sure.
if you're at an ESOP company and you're making those journal entries, are you really sending cash? Is there a reason for tax purposes or DOL regulation purposes to physically?
Yeah, in my experience, yeah, you're actually sending cash back and forth.
So that's a best practice to
Yeah.
send. We may
Yeah.
not see all of our clients do that, but that would be
Yeah, you're gonna want cash to move.
even
Good question.
for like the same day is okay.
Yeah, I mean, in terms of the specifics, I don't really know, but it's same day, next day kind of a thing where you know, you're seeing cash go out, cash come back in. It seems kind of silly, but that's what you need to do.
Thank you.
There's a lot of accounting that seems silly, I think.
Hey, where we're here, best practices.
Yep. So yeah, so a stock contribution accounting. So this would be company contributes stock directly to the plan. You know, that's recorded as an expense. And then hey, you're not reducing your cash, but you're the offset there in that entry is to common stock paid in capital. The other concept to think about here is accounting for dividends. And this is where it can get a little bit nuanced, but you always have to be thinking about your shares that the ESOP owns. Are they allocated shares or unallocated shares? Because it kind of drives how you treat these dividends or distributions. So in an unallocated share dividends, they're part of the compensation cost. So these shares haven't been allocated. So those dividends, they're not part of equity, but instead coded as an expense. The allocated share, however, of the dividends is treated how you would normally see a dividend or a distribution. It's something that reduces equity, and then again, unallocated portion of the dividend would be seen as a current year expense. So there is some difference between C Corp and S Corp treatment here, but C Corp dividends are usually a deductible expense when paid to the ESOP, and an S Corp dividends are typically not deductible. So moving along here. So related to the accounting for that unearned ESOP share release. So that's that inside loan, that contra equity account. So this is reduced every time that the company makes that debt repayment, or the trust makes the debt repayment back to the company. So annually, there's a decrease to the unearned ESOP shares for the scheduled release amount. And the portion that the trust, again, this is what we're talking about, the portion of the trust recorded as interest expense is not coded to interest income, but you hit it to the same account. So again, these come back. So the shares are released, you'll see, and this is at cost. In this example, if you had the scenario where you have a direct loan, trust makes a repayment to the lender, company makes this journal entry to reduce the liability in the unearned ESOP shares. But we'll focus more on when there's an inside loan. So contribution accounting, total compensation cost, something to keep in mind will be the average fair market value of the shares that are released. And the reason why they use the average value is because they essentially the employees or the beneficiaries of the trust are earning this benefit over the course of a year. So we don't just use like the end of the year stock price. What you have to do is say, okay, what was my share price value last year? What is it this year? Okay, take the average and then multiply it by the shares that were released for the year. And what you're going to see is as the stock price changes annually, there's this difference between the cost of the shares, the original share price when you bought the shares from the seller, and in the average price at the end of the year. And that difference is booked through additional paid in capital, which we'll go through in our example. And then for purposes of where to stick this expense, this ESOP compensation expense on your P&L, it's part of your operating expense or operating income. Okay. So getting to our case study, we'll go into some of the journal entries here. But in our example where, you know, the ESOP's bought 40% of the shares, fair market value, $75 a share. In this example, we've got an outside loan where the company also borrowed $3 million. And this, you'll see the terms are different. It's like what we talked about earlier from the inside loan. So we've got the company borrowing $3 million at a 4.5% interest rate. And so that you'll see is no different than what you're used to. If you got loans, you pay it. It's the same kind of accounting there. The inside loan, this is where things get a little bit different. So the company's got that same original $3 million loan, or the trust does. This loan, this inside loan here in our example, is over 10 years, and it's got a 1% interest rate to help make the math easy here. So the annual loan payment is going to be this $300,000 every year plus the interest on the outstanding principal balance. So every year shares are going to be released over this 10-year period, and that works out to be 4,000 shares per year. And so that number, you'll have this amortization schedule, the inside loan, that you want to pay attention to. But that's a key component here where we're paying attention to. Okay, every year 4,000 shares are going to be released. So then the other thing to point out here is, as a result of the leverage created by the ESOP and the company's performance, the average fair market value of the stock at the end of the first year is $50. So, they bought it for 75. The average value now is 50. And then another thing to point out, just so you can see the example here that I lay out, an additional $200,000 of planned contributions were made in this first year. Okay, so the first entry here to make is that outside loan repayment. I'm not going to go into detail there. You're paying cash. You're reducing your debt. You're paying some interest, just like normal. The next piece of this is the contribution to the trust. And so in our example, if you remember, they needed $330,000 to service the inside loan. So the company contributes $330,000, and then in our example, they also contributed an additional $200,000 to the plan. And so that's why we see cash going down by $530,000. And then initially here, we're booking compensation expense of $500. That's the principal paid of $300,000 plus the extra $200,000 contribution. And then, as we mentioned before, we're showing that interest expense separately. And that's just that 1% on the $3 million balance there.
Hey, Zach, can I
A lot of numbers.
Zach, let me pause you and ask if anyone's curious where the 1% interest came from, because that's a different interest rate than the bank rate. Could you maybe explain that?
Really, I think it's to make the math work. And really, you'll see kind of it nets itself to zero. So it doesn't often have that much of an impact here. And so, really,
I think a long time ago that AFR, a lot of time interest wasn't charged on these, but the ESOP community has followed what we see in estate and gift, related party transactions, where you have to charge some sort of minimal interest rate to make it fair arm's length market terms. So in this case, there's the applicable federal rate or AFR rate.
Yeah, it's well below that, right? Yeah, it's more right now. It's closer to 4.5%, 5%, something like that. Yeah.
So I think, and I don't know if the AFR rate is favorable. I don't know if is it more or less favorable if that rate changes a whole lot, Zach? In my experience, I wouldn't think so, but I also am not doing the taxes.
Yeah, I think there's a lot of different levels, like what we talked about when you're setting up the plan, extending the loan. Like there's a way to pull on different levers where, hey, if the interest rate is lower, you're going to pay it back sooner potentially, right? And so if you make the rate higher, maybe it's a longer payout, or, you lengthen the term to combat the lower interest rate or higher interest rate. So,
I think that covers Nicholas's question. The one other question that's come in from Kate is, have we seen many inside loans at less than 10-year repayment terms? I have not seen a lot under 10 years because
I am not either.
the
Yeah.
benefit level wouldn't be there, and you might have a problem as soon as all those shares are allocated in 10 years. You might have someone join the company and there's no shares to get them, so they don't get the benefit of owning. They still have an ESOP account, but it's not going to hold stock like.
Yeah, it's going to own cash or investments, other investments, right?
Yes,
Yep. That makes sense.
thank you. That
Okay, so if we keep moving on here, the ESOP, so how do we account for the ESOP trust loan repayment? And so this is where the money that's coming back from the trust back to the company. So, hey, we got our $330,000 back at the company level. Okay, we've made that payment, so now we can release 4,000 shares at $75 a share is $300,000. And then we've got this interest expense credit, so just offset that original interest expense that we showed on the previous slide. And then in this example, the share price went down, which is common in the first year when you're adding a whole bunch of debt to purchase the shares. In this example, share price went down, and so basically you have to calculate the difference between original share price and where it is now, and then that comes as a reduction. If it goes down, it reduces comp expense. If it increases, then it would kind of be reversed, where you'd increase comp expense and then increase your APIC. And then this here is just an illustration, so you can see it's more, so you can just check the math here. But I find this as a helpful reference where it walks through the company's debt payments, the contribution, the ESOP loan repayment, and then this fair market value adjustment. You can see in each one of these scenarios kind of what it does to cash. And really the thing to note here is what we talked about, like the ESOP loan, the cash moving back and forth, contribution to pay the loan, and then it comes right back. So like really the net of impact to cash was only that extra $200,000 that they contributed to the ESOP plan. And then here's the related impact to the, I think that takes us to our second polling question.
Yeah, that brings us to our second polling question. Everyone should see that up on their screen now. That question reads, ESOP compensation cost is determined based on the average fair value of released shares. Those answer choices are true and false. Give everybody, again, about a minute to answer these. We'll have one more of these before we wrap up today. I've got 75% of you answered, so I'll give everyone about 10 more seconds to get their answers in here. And then I'll share out those results and we can go over the correct answer. Last call here for that question. Great.
All right. Well, I think I heard Zach say that the average fair value is what is appropriate. So that would be a true answer on question 2. Okay. Well, we're going to get into some best practices here regarding the annual accounting and valuation cycle. So I think the best way to think about this is to think backwards from when do you want to release when you want to communicate the share price to your employees, is there a deadline driving that, or is there maybe a company party that's held in summer every year? The process is like if we start at the share release, the communication to the employees and work backwards, the first step back is the third-party administrator, the TPA firm. They're the one they're the provider that's going to process the share price and do the employee statements and so forth. But they need to know the final valuation. So if we back up from the third-party administrator's work, the valuation firm has to have complete information or mostly complete information in order to perform the valuation and communicate that to the trustee who ultimately approves the share price. If we back up from the appraiser, the person doing the valuation, they're at least going to want to start from ideally a financial statement draft from the CPA firm, whether it be a draft audited statements or a draft review. Speaking from experience, if there tend to be a lot of adjusting entries at year end, we really don't want to start our valuation with the internal company numbers, knowing that there are going to be some material adjustments. So typically we like to ask for the draft reviewed statements, for example. That also gives us the notes to the financials that are very helpful. But knowing that the debt balances have been accounted for, basically everything except the things that depend on our share price. So the ESOP comp expense, we know that number would change, but it may not change the valuation materially, although it would impact the financial statements and the profitability, for instance. So that's the way to think about it. If there's a specific deadline you need from the company's point of view, just communicate. Ask your advisors how long it takes, and assuming you get this piece of information by this date, how long would it take you to do your piece of the work? And then just add those up, and sometimes there's a cadence involved that can improve, but communication is the key here. We can move on to the next slide, Zach. So the chicken and the egg dilemma, like I just mentioned, the financial statements need the valuation, but the valuation can't be done without the financials. So using the draft at least helps us to get through the valuation process. The valuation firm then provides the share price to the trustee. That number is ultimately communicated to the accountant, who can finalize the year-end financials. Typically, they won't. Typically, while we can issue a valuation with a draft, the trustee will generally require the final financials before they accept the final valuation, the price, rather. If you are an internal, sorry, we'll get to that on the next slide. I had a thought there. If you want to book some sort of ESOP comp expense and you don't have the current price yet, you can always use last year's price and then adjust it when you know your final answer. So we can move on, Zach. So what can help you from the valuation perspective? Being organized is incredibly helpful for the person that's going to do your valuation. A lot of appraisers will try to perform an income approach, and forward-looking, we might call that a discounted cash flow analysis based on the company's projections. What I recommend is every year, have an Excel file, put your forecast in that file, save it, 12/31/24, for example, get through the process, send that to your appraisal firm, and then the next year when you update it, just make a new tab and keep sharing that, because projections are really helpful to see year over year. You might be surprised that you are maybe your business is tends to be accurate, accurate in its forecasting. So the appraiser might get comfort in knowing that you're mostly correct or accurate. Obviously, if there's been a big change to the company, for example, a customer loss, maybe a change in strategy, technology, those are very important things to communicate if you think it's going to change your future. And valuation, some variables are very sensitive, and so if there are changes to those, it can impact the answer quite substantially. So those are the things we're looking for when we value the company. It also helps us if you know the information in our report, like employee count, key employees, the board of directors, and if you provide that up front, that's always helpful to delay finalizing the report later, waiting on those final details. So just getting ahead of this every year is very, very helpful. The appraisal firm should provide a request list to the company, and just maintaining a folder of that every year so you know what you're going to get, and if you can get ahead of that, you're going to probably get to the top of the queue, and the more organized you are and the faster your financials come through, hopefully the valuation firm is ready to work as soon as they have those items. I happen to work with one client that I don't ask them for anything because they just send everything. I don't even have to ask. It's the request list that we sent them on the very first year that we worked with them, and they have clearly tick marked all items and all the supporting detail, and it's extremely helpful. It's very efficient for us, and it's one of the faster ones we can issue. Go ahead and move forward a slide, Zach. So what does a trustee do? We do need to account for the period of time that the trustee needs to understand and review the valuation before they can accept it. And this varies by trustee. Certainly if it's an institutional versus single trustee, sometimes there's a 3-day kind of pause between when we have to send them the valuation and then we meet and present to their committee, which is can be a formal process, and it's definitely allows for Q&A and some good discussion and overview about what happened to the ESOP over the year and what's driving the share price change. Of course, if you're an internal trustee, you want to document the same process to the extent you can. You want to ask questions, email your questions, document that you've reviewed the evaluation report and that you're wearing the right hat, not as the company officer at the time, but as the fiduciary in that role. So go ahead,
Dan,
Zach.
yeah, Dan, I had a question for you.
Sure.
So when you start the process every year, or do you generally like schedule a call with your clients to go through, for example, like if you've got projections that are way higher than maybe the previous year or way lower, do you find that helpful to have those conversations up front, or to what extent are you using these conversations or narratives that they're providing early on?
Yeah, certainly. We look at last year's projection and we see, did the company hit revenue, exceed revenue, or miss revenue? Same thing with EBITDA, and maybe some other elements. We want to understand the CapEx that they said they were going to spend $1 million of capital expenditures. Did that happen? Was it more and was it less? We just want to compare the what they said or thought they were going to do versus what actually happened. And then from there, we look at their last year forecast and layer on top the current year forecast. It's a little bit like parallel shifts in interest rate For instance, like, is every year going forward getting better, or maybe they end up at the same place, but they know they're going to get a bump for a year, or maybe there's an issue and they need to bring down the forecast for a year, but they think they can recover. I mean, there's all sorts of shapes it takes, and it's really on the appraiser to decide, how to treat that, how that's ultimately going to impact evaluation. But yes, we absolutely will have a due diligence call with the company on every project. We will talk through those kinds of things. So it's hard to schedule that meeting without getting information. It doesn't necessarily have to be the CPA draft statements, but we really like it to be. That's the most efficient, and that's what drives the fastest kind of turnaround from the valuation point of view.
Okay. Right. So then, obviously we've got 5 minutes left to go. So we're not going to be able to go through all of this here. I guess if you guys go through it on your own, if you have questions, let me know. There's a couple different nuances in the second example, this year two example, pay attention to. One being that in this one, there's a distribution made. And so you have to pay attention to the allocated shares and unallocated shares, and there's an impact that you'll see on the financials there. But again, if you have questions after going through it, we're happy to help answer that. And I don't know if anybody had additional questions.
Yeah, if we could go to that last polling question slide, if you're ready for that
Yeah.
there, and then attendees can, after they answer here, put any of their own questions they might have that are lingering from today that they're thinking about. Go ahead and put those in the Q&A or the chat. This is a true-false question. Same as always, going to give everyone about a minute to get their answers in. In our last, we have 4 minutes here left over.
So yeah, and this one, differences between book or GAAP net income and tax net income can result from recording ESOP compensation expense. We didn't really get into that in that second example, but as you can imagine, there are often differences between how you're supposed to treat things for GAAP versus what the IRS says you can do. And so I think you probably going to get this one right, that that this is true.
Looks like 88% of you said true there. So good work, everybody.
Zach, for 100% ESOP, does that matter, practically speaking, if there's a book and tax difference?
Well, no, not really. It could for maybe state tax purposes, but oftentimes, and this again is a different subject for a different time, but if you're 100% ESOP owned and you're an S corporation, you're exempt from paying federal income tax. And so to answer your question, if taxable income is higher or lower for federal purposes, no, it doesn't necessarily impact the ESOP trust because they don't pay tax.
One of the many benefits of the ESOP structure.
Yeah.
Okay, well, that leaves us in our last 2 minutes. Zach, Dan, is there anything you want to add before we just simply say thank you for spending an hour of your Tuesday with us, putting this together, and putting all this out for our attendees today?
Dan, you have anything?
I don't. I just noticed a question come through the chat as opposed to the Q&A. Why don't I read this question? We'll end on that, Maria. Is that okay?
Yeah, go ahead.
It says, Melanie writes, would it be sufficient to have the internal loan set up with principal and interest, but bypass the interest entry that offsets for the company, posting the difference of average share value or comp expense and the payment total amount representing interest and principal to the additional paid in capital account. Well, that sounds like an accounting question, so I get to defer that to Zach.
Yeah, I work better with pictures. I'd be happy to answer that question offline. But I know there are different ways to come up with your journal entries to end up with the same result. And so maybe this is what you're saying. And it's possible, but I would have to see the entries. Happy if you want to shoot me an email and go through that specific example. I'm happy to help.
Well, that feels like a good transition. We're here at our 30-minute mark. You guys will hear from our team later this afternoon with follow-up contact info for both Zach and Dan, and then myself as well in case anything comes up. So thank you everybody for spending an hour of your Tuesday with us. You'll get replay, slides, your certificates, all of that. So thank you, Zach and Dan, for being here with us today. Hope everyone has a great rest of your Tuesday.
You too, Maria. Thanks a lot for
Bye,
hosting.
everybody.
Take care.